Today is May 29, 2026, and digital asset prices are currently pinned in this really tight holding pattern right around $73,375. Welcome to the deep dive.
Glad to be here.
We know you follow this space closely, so we're just skipping the basics today. Our mission is to analyze exactly why speculative capital is vanishing in real time and, how the underlying institutional plumbing is just fundamentally rewiring itself.
Yeah, the landscape is shifting incredibly fast right now.
Okay, let's unpack this. We are seeing a massive synchronized outflow from both physical gold and spot Bitcoin ETPs. It's almost like watching investors simultaneously sold up their financial umbrellas because they realize the inflation storm is finally blowing over.
That's a great way to put it, and the JP Morgan data actually backs up that exact shift. The whole debasement trade that completely defined the last year is rapidly cooling off.
Right, so capital isn't just rotating between different hard assets anymore.
Exactly. It's abandoning the inflation hedge thesis altogether. What's fascinating here is the direct catalyst, which points straight to the drafted 60-day U.S.-Iran ceasefire.
Now, you might be wondering why a diplomatic ceasefire in the Middle East instantly drains capital from U.S. crypto markets. But it really all comes down to the mechanics of oil, right?
Yeah, that's the core mechanism. This ceasefire specifically mandates unblocking the Strait of Hormuz.
Which is huge.
Right, because 20% of the world's crude oil flows through that one maritime choke point. So reopening it acts as this massive deflationary shock.
Global energy input costs just plummet.
Exactly. It drastically reduces the threat of supply-side inflation. So almost overnight, that panic-driven need to hold a non-sovereign hedge just evaporates.
So if that macro fear is evaporating, what happens to those massive corporate whales who, built their entire balance sheets, assuming inflation would just keep rising?
Yeah.
We saw Strategy move over $30 million in Bitcoin to Coinbase Prime.
Yeah, the 411.48 BTC transfer.
But wait, I'm confused. Strategy is famous for hoarding. Why would they move that kind of capital to an exchange right after spending $1.38 billion in cash on debt restructuring? Are you saying they're actually preparing to liquidate to cover liabilities?
That's the most logical read of the board right now. And to your point about how they moved it, they executed a microscopic test transaction first. Just 0.0241 BTC.
Testing the waters.
Exactly. It shows extreme operational caution, like testing the ice before driving a heavy truck across a frozen lake. Prediction markets on Polymarket are actually pricing in an 84% probability of a formal strategy asset sale by year-end.
Oh, wow.
Yeah. But it's not just corporations feeling the strain. The mining sector is hitting a massive wall, too. Bitfufu just posted a $35 million net loss for Q1.
And for you listening, a $35 million hole isn't just a bad quarter. That's a structural crisis.
It's the harsh reality of network difficulty. Because more computational power is constantly competing to solve the exact same cryptographic puzzles, Bitfufu is burning the same amount of energy, but extracting way fewer rewards.
Right, and you combine that with massive non-cash depreciation on the assets they already hold.
The cash flow crunch becomes severe. It raises a really important question about how sustainable pure-play mining models even are without constantly rising prices.
Right, so demand is weakening, miners are bleeding cash, but ironically, the actual plumbing of the market is getting a massive upgrade. Here's where it gets really interesting. The CME just permanently launched continuous 24/7 trading for crypto futures and options.
Finally.
Right. Does this actually kill the infamous CME gap? Because, think of the weekend gap like a pressure cooker left on the stove. Traditional markets close on Friday, news built up pressure over the weekend, and by Sunday night, the lid blows off in a huge price spike. Does 24/7 trading install a permanent release valve?
It acts exactly as that release valve. It removes that unhedged weekend risk that institutional managers historically had to just, carry until the Sunday open.
Which they hated doing.
Exactly. They can now balance their books in real time, which creates a continuous market equilibrium. And if we connect this to the bigger picture, this maturation aligns perfectly with Treasury Secretary Scott Bessent formally rejecting a U.S. central bank digital currency.
So what does this all mean for the digital dollar then? If the government steps back, it leaves a massive infrastructure vacuum.
Well, they aren't abandoning digital dollars. They're effectively outsourcing the job to private stablecoin issuers.
Ah, I see.
Yeah, by stepping away from a CBDC, the government is letting private enterprise build the financial highways while the state just retains the power to regulate the traffic. It's a massive maturation of the ecosystem's rails.
Bringing this all together, this structural shift matters to you because the era of wild, retail-driven weekend volatility is ending. It's being replaced by calculated institutional equilibrium.
The plumbing is institutionalized, the geopolitical premiums draining out, and those dramatic weekend swings are just being systematically engineered out of the system.
Which leaves us with this final thought. If this asset is no longer predominantly traded as a panic-driven geopolitical inflation hedge, and it now operates 24/7 on regulated, institutional rails, will its next major valuation cycle be driven entirely by actual transactional utility rather than global fear? Something to mull over as the market grows up.